Well, welcome back, ladies and gentlemen, and welcome to this session on scaling up and life after the crisis. We're going to be looking at the getting back to business with car plants restarting and showrooms open again. But still lots of questions about what the future looks like for companies and demand and all the future trends we hear so much about, such as electrification and autonomy. Please do be sending your questions in during this session using the window below the screen. And we have three speakers during this session offering a global perspective on the crisis. We have Bill Russo, founder and CEO of Automobility from China. We have Dan Levy, the senior auto analyst at Credit Suisse based in the US. And we have Liam Butterworth, CEO of GKN Automotive, who's based in the UK, but has operations all over the world. So we're going to have a short video now to hear from our speakers before we go to the discussion.
Global auto production this year is expected to be roughly 68 million units. That's down nearly 25% from last year and represents the lowest annual global auto volume since 2009 when we saw the financial crisis. We think by next year volume can recover roughly 15%, which would still put global auto builds at only 80 million units. That's the lowest number ex-2020 since 2011.
We don't believe that we're going to see volumes coming back to pre-COVID levels for around 4 to 5 years.
Due to effectively having achieved containment in China, we've experienced 2 months now of year-over-year growth, and the industry has largely resumed pre-COVID levels of capacity availability.
We're looking now very hard at our footprint, at our installed capacity, and to make sure that we can continue to right-size and adapt our business to maintain a very lean, flexible manufacturing model.
Regionalization of sourcing is a likely scenario which effectively would de-risk supply chain disruption, but will add significant costs to the system.
At least in the US. We'd argue auto companies have proven themselves much more resilient today versus 08-09, with better liquidity, cost structures, and product focuses, allowing them to better manage through this crisis.
The COVID-19 outbreak is an accelerating moment for digital disruption and could force automakers to pivot to new opportunities in order to sustain their long-term viability.
Industry consolidation is something that's been talked about for quite some time and has been happening for several years. Really, as a result of COVID, our view is that's going to accelerate, and clearly there's a number of key themes across the industry around electrification, autonomous, and mobility. So it's really going to be important that where we see a lot of suppliers starting to collaborate, consolidate, and get together and start to adapt their businesses to be able to cope with the lower volumes, but also to be able to share investment and R&D cost across these large platforms and large investments that are required.
While we think there is recovery ahead, the manufacturing crisis of today exacerbates a dilemma for the auto industry that we've cited as the challenge of the two clocks. With reduced liquidity, greater debt loads, and squeezed margins, we'd argue there is a greater challenge for auto companies to adequately invest to meet the future secular shifts of vehicle electrification and autonomous driving.
Ramping up our business is all about making sure that we've got a very flexible business model and we've got the ability to adapt in a very quick and reactive way. A key challenge for us is really just to continue to stay in very close contact with our customers, daily contact with our customers, understanding what their demand short-term and mid-term is going to be, and also then making sure that we're in very close dialogue with our supply base so that we can flexibly adapt our supply chain to future demand. But we're obviously not going to be making any big incremental capacity decisions in the short term because of the level of uncertainty.
Well, lots to think about there, and joining me live are our three speakers. Gentlemen, let's start with the question of demand and the recovery. How dependent do we think that the short-term recovery of market demand is going to be on government incentives and scrappage schemes? Bill, maybe you could start, because obviously China is further ahead in this and has actually seen what appears to be quite a decent bounce back.
Yeah, I think China's on the other side of containment, and we've seen both recovery in production. Industrial production in April was up 3.9%. The first quarter obviously saw a huge contraction. The GDP overall in China was down for the first time in decades, in over 20 years, minus 6.8. But we've seen a bounce back in industrial production. We've also seen a recovery in retail sales with year-on-year growth in automotive in April of 4.4%, followed by a May number of plus 11.7. That's in part due to pent-up demand, in part due to government demand stimulus, especially for commercial vehicles. The commercial sector benefited from state-owned enterprise investments and replacement demand. So I think that's fueled the recovery, at least for part of the market. The passenger vehicle market still has some challenges going forward.
Sales just fell. They've been rising for almost 30 years, and they've been falling in the last couple of years. Dan, can I ask you, what's the situation in the US? I know there's a lot of calls there for this kind of cash for clunkers scheme, a scrappage scheme. Do you think that's realistic, and how are you seeing demand for the rest of the year?
Yeah, the interesting thing about the way the U.S. has played out in the crisis is that the bottom was never as severe as people expected. So just to give some perspective, in late March, there was an expectation that April sales could be down as much as 80%, and that never really materialized. April sales were only down roughly 45%. May was down roughly only 30%. If we look at retail sales at this point on a weekly basis, we're almost at nearly pre-COVID levels, which is quite amazing given the labor shock that we've had. And actually, the difference between, call it the US and a place like Europe, is that at least in the US right now, there's potentially a much tighter inventory situation. So even if a scrappage program went into effect, I don't know that there would be the stock, at least immediately, to support that. The only caveat I would say is that don't underestimate that this is an election year, and certainly the additional support for the auto industry would be something that could go well in an election year.
Yeah. Now, several of you talked about prospects over the next few years of recovery by 23 or 24 or 25. What are your assumptions around that? Is that assuming that we get a vaccine quickly? If there's a second wave or sort of prolonged outbreak, is that going to set that back significantly? Liam, maybe I could come to you on this.
Yeah, so we've obviously been looking at all the various industry forecasts that are out there in terms of the recovery. And I would say, since 2017, we've seen a gradual contraction of volumes up until last year. Obviously, COVID has accelerated that reduction in volume. And our assumption is that we won't see anything like 2019 volumes for at least another 4 to 5 years. So obviously, we're managing our business accordingly to take that into account. Now, obviously, if there's a vaccine, that could accelerate a recovery. But clearly, we're planning for a prolonged down period of global volumes.
And we've all seen a bounce in Chinese demand. Do we think something like that is replicable in Europe? I mean, Liam, you're based in Europe. What are your thoughts on this?
Yeah, I kind of reiterate what the other two panelists said is when I look at our business, we've seen a very strong recovery and rebound in China. We're also looking at our North American volumes have actually surprised us how strong they've come back following the reopening. Europe tends to be a bit of a mixed situation across the different countries where we're operating. Clearly, the incentive schemes in France and Germany are starting to have an impact, and Spain obviously recently announcing their program. So that's starting to have an impact, but I think there's also an element of pent-up demand that's out there, and people also waiting to see what kind of incentives will be offered in the UK before obviously going out to where to make new vehicle purchases.
What about long-term changes to the industry? There's been a bit of a decline of private car ownership, or at least the appeal of private car ownership. worldwide. Bill, you're seeing that go into reverse now in China after this, presumably because people are worried about public transport. Do you think that's sustainable, or do you think that's a short-term bounce?
I think the migration of people away from public transportation into more personalized mobility is definitely a trend, has been a trend for some time in China, accelerated now with COVID. Now, what COVID did is it caused people to move less. I mean, COVID spreads with people. It travels on people's lungs, and our movements are what causes it to move around the world. So I think people are moving around less, but when they are moving around near their home, they prefer to do it not in a large petri dish like a train or a bus, but in something a little bit more personalized. What we're seeing in China is a boom in the, I would call it micro mobility segment. And unlike in the West, we're actually seeing a significant bounce back of mobility services. Remember, in China, 9 out of 10 people do not own a car. Most people do not have access to a car, and even if they had one, they don't necessarily want to take it to work every day. It's not a convenient place to move around in crowded cities, and cities here are densely crowded, much more densely populated than anywhere else in the world. What we're seeing is a significant migration of people from public to private transportation, but that doesn't necessarily mean personally owned vehicles. That will get a little bit of benefit, but the significant benefit is moving into micromobility and mobility as a service.
It's interesting that we've seen a lot of car companies write off in the last few months previous investments into particularly shared mobility and access to shared vehicles. We'll see if that changes the long-term future. Can we talk a little bit about the industrial footprint out of this? I think everyone saw, certainly in the first few months of the outbreak, quite how exposed they were to China. I remember talking to one global CEO about whether they'd be affected by the Chinese outbreak in their Western plants. And they said, yes, but we've no idea where, simply because we just don't know how integrated we are into the Chinese supply chain. How feasible do you think it is to cut China out of the supply chain? Do you think we're likely to see a global rewriting of production plants and supply chain plants because of this? Liam, you obviously have, you're in the supply chain, you have plants all over the world.
Yeah, so it's a great question. So one of the things that we've been focusing heavily on with the GKN business over the last couple of years is really looking at our global footprint and really making sure that we've got regionally installed capacity to support the local markets. So China, is a very, very important part of our business. We've been operating with our JV partner there for about 30 years.
I think one of the, a constant reminder that virtual summits do occasionally throw up technological problems. Bill, can I come to you on this until Liam comes back online? Do you think it's possible to get China out of the supply chain?
Well, very difficult. It's not just a matter of where you get, I think the one thing we can say with certainty is the concept of low-cost country sourcing, where you tool up once and build to huge scale in one place, is not it's a fault intolerant business model. You cannot rely on supply chains when you have things like earthquakes or floods, or in this case, a pandemic that starts in one part of the world. But interestingly, we've kind of gone from a pendulum swing of questioning why everything's in a low-cost country like China, which, by the way, is not as low-cost a country as it was years ago. But where can we locate supply chains to de-risk the potential of a force majeure event? But what we're finding is that supply chains in China are not just because of low-cost country anymore. It's also because of infrastructure and being able to get goods in and out of the place. So it's the total cost of the delivered solution that is the sort of the holy grail of sourcing. And right now, it's hard to displace it from China because not only is it an efficient place to build things, it's got the infrastructure necessary to move things in and out, which are difficult to replace in other parts of the world.
Dan, what's the North American perspective on this? There's obviously been some footprint changes there because of the renegotiations over the NAFTA trading agreement, and Trump is clearly quite keen to bring manufacturing back to America if he possibly can. Do you think that's realistic at scale, or do you see little change in the future?
I don't see as much change. I think the one thing to emphasize is the supply chains, for the most part, are fairly localized, meaning you produce in region for region. So in North America, or at least in the US, for instance, something like 85% of the US auto sales annually are produced within North America. The one thing I would point out is, I think obviously with the trade tension that you saw last year, there were a number of companies that, to the extent they had supply chains dependent on China, they looked to mitigate some of those impacts, to limit some of those trade tensions. Just remember, vehicles have tens of thousands of parts in them. So even if the vast majority of components in a vehicle are locally sourced, you still may have some components that are dependent on China. So it'll be very difficult to completely eliminate China from the supply chain in regard to North America, but in general, mostly localized.
Yeah. Liam, can I come to you? You were slightly cut off by technology when you were finishing your last answer. So can I ask you to finish that, and also to give your perspective on the UK as a base for manufacturing? We've heard a lot in the last few years since the Brexit vote about UK competitiveness and whether it's going to be challenged by Brexit. Can you just give us your brief thoughts on that?
Yeah, so I don't know where I got to, but just in terms of our business in China, just reiterating what Dan said is we're very localized to support the local market, and all of our investments in China are for the local Chinese market. And I would say the downturn that we've seen as a result of COVID has actually forced us to accelerate our moving away of sourcing from China as well and going to more of a regionalized sourcing model. So we've got a much more flexible supply chain. Now, in terms of UK as a manufacturing base, clearly we continue to look at all of our installed capacity in each of our regions. And as you are fully aware, the pressure from the OEMs is tremendous and is actually increasing now as a result of the lower volumes. So the pressure to be globally competitive is very strong for us. So, we continue to look at our installed capacity and the cost competitiveness of each of our locations. UK is clearly not a low-cost manufacturing location for some of the low complexity manufacturing systems that we have in our facilities. So we're continuing looking at our footprint to make sure we've got the most cost competitive footprint and best utilization of capacity.
If you have to move to a kind of regional production model where you're making the same stuff in China and in, say, Central Eastern Europe and in Mexico for your respective markets, is that going to make your business less profitable overall?
It's a constant trade-off, to be honest, in terms of looking at what does it mean from a working capital standpoint, what does it mean from a logistic and the logistics cost, and then obviously taking trades and tariffs. And we're actually finding in many cases it does make sense to duplicate capacity across regions when you take the holistic view of the cost structure from material into material delivered to our customers.
We're going to take some audience questions now. Thank you for sending those in. Please do keep those coming in. We'll try and answer as many as we can before the end of the session. A question here from Ian Henry at Auto Analysis, and it's about Brexit and rules of origin. Do you think you can actually bring more sourcing back to the UK if we end up with trading arrangements that have bad or no rules of origin agreements? Liam, I guess this is a question again for you.
Yeah, clearly Brexit is something that just adds more complexity at the moment and uncertainty, but we are continuously looking across our supply base for the best, most cost competitive suppliers with the best technology who can deliver parts as and where we need them at the best quality possible. Now, if that supply base exists in the UK, then clearly we will be very happy to increase the amount of sourcing out of the UK. But clearly, it really depends on the total supply chain cost and quality and technology that's available.
But surely, given the implications of not clearing rules of origin thresholds for FTAs, would it be right to assume that you'd be far more likely to pick a UK supplier, even if in the old world they wouldn't have been as competitive? I mean, does the UK tier 2, 3, and 4 industry exist to an extent that there are viable UK options if you have to look at them?
Yeah, of course, we would continue to look at and look even harder at the UK options should it make sense. I think the concern that we've got right now is how are those tier 2, tier 3 suppliers going to weather the storm, really, once we come out of the COVID downturn. They need to fund the working capital to rebound, and we're obviously very concerned about our supply base and ability to have a healthy long-term future. But going back to your original question, of course, we will continue to look at across the UK to see where there's options to increase sourcing should it make sense for us.
Yeah, thank you. We have another question that's coming in, and it's on Brexit again. Clearly a popular topic from Eric Albert at Le Monde. For all speakers, actually, is how do you see Britain's place in the global automotive industry? On top of the challenges of COVID and electrification. Could Brexit be a fatal blow to the industry? Now, Liam, to give you a break, because you've answered lots of questions on this, Dan and Bill, can I come to you on this and just ask, what's the perception of Britain overseas as an automotive centre? Don't all jump at once.
From China, yeah, I'll start. I think viewed from China, it's a place that has deep engineering competencies and historically strong heritage and brands. So I think, product-wise, it's viewed as a product engineering and, a product engineering a deep place. As a manufacturing center, you really have to question where is the strategic advantage other than protecting jobs for workers in country. What's the strategic advantage of being a manufacturer in a business of mobility, in the business of providing platforms to facilitate people and goods movement? Is that the most lucrative place to place your bet if you're trying to get a high return on your investment? And that's, I think, a strategic question for the whole industry. But I think because of Brexit, it really raises the question: is this the core of our business model, or should it be something that generates revenue after the sale? Should we be a more service-centric business providing mobility for people to facilitate people and goods movement? That's what I see happening here in China. Manufacturing is less attractive, so China's not really as concerned about losing some of the manufacturing jobs and regionalizing its production footprint.
Do you think that so go on, Dan.
I was going to say, the only thing I would say is I agree with Bill, the importance of the brand legacy, but one thing to consider in the automotive industry is just cost. Brexit increases cost, and I think one of the biggest questions in Europe today is the onset of electrification. We're not there yet on the cost perspective, and that cost increases in other areas as well, including from Brexit. That just makes the question of EV affordability much more challenging. And we know that EV penetration is still very much a central focus in Europe. So it's just a matter of considering the costs as well.
Look, final question for each of you before we close. We've talked about the virus and the pandemic accelerating changes we've seen in the industry. Can you give any specifics on what you think is going to change as a result of this long term, whether it's on electrification, autonomy, a kind of new normal of consumer behavior? Bill, can I come to you first?
Yeah, I think, first of all, long-term direction should not be abandoned in a crisis. If the crisis causes us to pull back our strategic view of electrification and autonomy as critical technology, connectivity, electric and autonomous technologies, then we've lost. The question you have to ask is, how can I rapidly repurpose my capital investment strategy and reconfigure my investments as the value chain shifts from people movement to more goods and services-oriented mobility investments. We've seen a tremendous acceleration of investment in autonomous driving for goods delivery. And I think automotive companies that focus only on people movement may actually fall behind as a result of Brexit, or as a result
of COVID, exactly. Dan, very briefly, you think this accelerates your two clocks thesis you've talked about?
It does, and simply because only into this crisis, you now have players in the industry that are now working with relatively less liquidity or tighter balance sheets. The margins are squeezed, so it just does make the choice of how you're budgeting just a little trickier. We do think electrification is something that remains more on track given regulatory impetus. Autonomous, though, is something that maybe gets pushed out a little bit and really reinforces that the larger players are going to be the winners.
Liam, final thoughts in 15 seconds, if you will.
Yeah, I think three things. Electrification clearly accelerating in terms of investment and volumes, especially across our portfolio. The second one is flexibility of supply chain. That's really been emphasized. And the last point I would say is, we shut down 52 manufacturing facilities from our living rooms and kitchens. So the use of technology to run a global business has really been coming to the forefront and in terms of how we can effectively use that to run the company.
And I think today's virtual summit is probably a testament and a great example of that. Look, thank you all for your thoughts, Dan, Bill, and Liam.